What is going on, you guys? All right, going to get all settled in here. Just going to give this just a second. Okay, so I'm going to actually record this, and this is going to be both on YouTube and on X. So the recording will be on both platforms, YouTube and X. Wanted to make sure that I actually still came up here. I wasn't able to make it last night because my wife was leaving to go on a work trip, actually, and I ended up dropping her off. So that was last night was Sunday night, and I made sure that I dropped her off. And we live about an hour and a half away from the airport, so obviously you could see that really cut into my usual time when I go live. The reason why I go live at that time in the first place, that has the highest amount of attendees. So I figured that I would make sure that what I prepared for yesterday, I was talking about here today. And the reason why I wanted to make sure that I was still talking about it is that there's actually a lot of things that are going on in the markets right now. Like right now, this week is going to be inflation week. And that's why I think that, hey, what's going on, Sam? This week is inflation week. And it's actually a really, really important week. And I'm going to talk a lot about that. So, okay. I've been listening to earnings calls pretty much. So what I do for a 9-to-5 job is I'm in pharmaceutical sales. So that means that I spend a lot of time out on the road. Every single time that I'm driving from location to location, sometimes my drives can be 4.5 hours. Sometimes they can be 30 minutes. But I'm usually listening to earnings calls is what I'm usually doing, or listening to like J Pow talk or whatever it might end up being, economic commentary, and just making sure that I'm always plugged in and stayed in the loop. And what I've really been able to grasp so far is that right now the economy is not in the best of shape. I know that some companies are coming out with better than expected results, but as far as it comes down to like what I'm seeing out there is that I'm seeing a pretty consistent worry across the board. I think that the best way to describe it is like almost like a general malaise, that something is going to happen. And I think that that's actually being baked into a lot of companies' forecasts, that they're seeing this weakening in the consumer, specifically in interest rate sensitive sectors. So what I actually can show you guys this right here. So I was planning on just rolling into this. I actually have a lot of things to show you guys. But I'm going to shoot over to this right now, where I think that right now the vehicle market is the one that's being impacted the most. And you can see that in multiple semiconductor companies, as well as like Tesla's earnings. I know that some people mentioned that GM is still doing well, but and now don't correct me. I didn't actually look too much into GM's earnings call. I think that their forward PE is 10, and it's for a due reason. Sorry, I had a little notification there, and it's for a due reason because it has a high debt load and it's just a mature company. There's some growth, but not too much growth. But basically, from what I'm seeing out there is that the vehicle market is absolutely getting whacked. And you can actually see this right here, that the price changes on a year-over-year basis. So even though the EVs have been the center of attention, compact cars are down just as much, if not a little bit more than EVs, mid-sized cars. So basically, it's across the market. Right now, what this isn't just going to be the vehicles that are going to be really impacted, but this is also being felt by solar companies, a lot of tech companies. From what I've seen so far, especially if they're not mission critical tech companies. So what we're seeing is there's definitely a slowing, and there's definitely the consumer is definitely being pressured. I also think that you can see this in like Starbucks earnings. I know that Starbucks is they're really not innovating too much. Starbucks is Starbucks. But that's a really great way to gauge out like whether or not the consumer is spending on like discretionary things. So $5, $6, $7 coffee is discretionary. You don't necessarily need to have a $5, $6, $7 coffee. You can get Folgers for like $15 for 30 cups of coffee, whatever it might. I don't drink coffee. I drink Reigns, which is a Monster Energy drink. But I know that I also have some business partner friends too that they've mentioned that they've actually seen this slowing down of the consumer. Now, what we ended up seeing on Friday was what I actually wanted to point out to you guys. So I think that this is actually a really solid time to actually go into what I was going to talk about. So what I'm seeing here, and this is just to really kick things off, like from the beginning part of the year, the 10-year yield has steadily rose. Now, what's been really interesting is that recollect about 4 or 5 months ago when we came into the year. So it was like December's FOMC presser when Jerome Powell came in and he said, they were basically guiding for rate cuts. I think they were saying like 2 or 3. The market got way ahead of itself, and the market said, that they were going to cut 6 or 7 times this year. this was actually felt in high beta stocks. So coming into the year, a lot of high beta stocks, long duration stocks were pricing in all of these rate cuts. And I think that you can actually really see that in the 10-year yield from the recent October high, and then it essentially bottomed out. And then to begin the year off, we've just seen a steady drift up. Now, this has really been predominantly led by a lot of the inflation misses that we've had. So you can really see that here. And this is the last inflationary print. Now we have PPI tomorrow morning. We have CPI on Wednesday. So what we've actually been seeing over the past 3 months, and I think that this right here is probably the most important chart to be aware of, is that inflation right now has been a top concern and a top worry of a lot of different investors. So now it's not so much about, hey, are we going to cut rates? I do know that if it wasn't for Jerome Powell actually clearing it up on this last call or this last FOMC presser, I do think the markets, if the inflation data comes out worse than expected on probably Wednesday, because PPI PPI has actually been responding really well. And that's probably been the more beneficial thing. So basically PPI is coming in weaker than expected, while CPI has been coming in really hot. That I do think that has been led by energy. But more or less what I'm trying to say here is that the recent couple months inflation, so that 3-month annualized inflation, you can actually see that that's been really accelerating over the past few months. Now, this is a worry and this is a concern, and it has been led by energy, but it has been led by other areas of the market. So like even wage growth came in a little stronger for the past couple months, and now CPI. Now I do think that the markets are actually really concerned about this, and you can actually see that in the rising 10-year yield. And then also, and this is going to be the whole point of what I'm going to be talking about here today, is that the question becomes, are we actually going to see an acceleration in inflation and higher bond yields? And if so, what is the result of that? Like, are we actually going to go through a recession? Like, what is the overall worry and concern about the markets? Because I don't necessarily want to come up here and talk to you guys and like try to regurgitate information that I've seen everybody else talk about. I really want to make sure that like, where are we at in the cycle? Like, how is this going to transpire? What does this mean for our portfolio? What does this mean for our portfolio results in the next, let's say, 3, 6, 9 months? And from what I'm seeing, essentially, is that this inflation issue is actually a really big problem. So I think that couple that with, so like what we ended up having too was the inflation expectations coming out worse than expected. Okay, I got to just talk on this just for a second here. So bookmark that in your mind. We're going to do a little bit of a history lesson here. So inflation is always, so like as Milton Friedman quoted, is that it's always a monetary phenomenon, basically meaning that the money supply increases too fast for consumer goods to really be able to catch up. But what ends up happening is that acts a lot like the light, like the match that's lit on, and it's thrown on gasoline, basically, right? So when you print a bunch of money, everything, that's essentially like the catalyst, right? But what makes inflation so sticky is that it's actually going to be inflation expectations. Because what ends up happening is that you end up creating this spiral of like consumers and businesses expecting inflation to continue to go up. So what ends up happening is that businesses will continue to raise their prices in the anticipation that inflation is going to continue to go up, and they're going to pay their employees more. So what ends up happening is you have this indirect result of like a self-fulfilling prophecy. So inflation kind of becomes a cycle after a while, and it becomes and so as famously quoted by Paul Volcker back in the late 1970s, early 1980s, is the only way to actually be able to crush inflation is to crush inflation expectations. So as you can see that when we have inflation expectations coming out really hot on Friday, I mean, the recent weakness that we've seen in the markets does make a ton of sense. Because when you actually see inflation expectations become unanchored like this, only in the short term though, so there is some saving grace. The long-term inflation expectations do seem to remain relatively anchored. But when you see short-term inflation expectations like this go up, this is really concerning, right? Because you don't want that inflationary spiral to actually kick off. And also what was equally as concerning here, so this is actually a really big portion of my screen. I try to see if I can zoom out for you guys. I think that you guys can still see that though. So like the consumer sentiment was also really concerning because it was a huge miss to the downside. So when you actually couple inflation expectations going to the upside and then the consumer sentiment coming to the downside. What this essentially means is, this means that we're actually transitioning more towards a stagflationary economy. Now, this is really concerning, and this is, I think, partially what we're actually seeing out there. And it's like the very, very beginnings of, and like, I do think the policymakers right now, they have a choice to make. And I think that even like as the elections start coming up, and I'm not going to get too political on you guys or anything like that, because I want to make sure that I'm staying as unbiased as possible. I do think that as the election comes up, I do think that this is weighing on a lot of voters' minds right now. I also think that this is weighing on a lot of money managers' minds. Is like, okay, we are at a very important crossroads right here, where are we actually going to transition more towards a stagflationary economy, or are we going to have a hyperinflationary economy? Are we going to have a recession, which is also in the cards too, because you still have that inverted yield curve. Like, what does that mean looking forward, right? Okay, so essentially, we got all of this coming out here on, so like we're going to really be able to figure out a lot more about how this is all going to start playing out on Tuesday and Wednesday. So we got PPI coming out tomorrow morning, and we got CPI coming out on Wednesday. Now, the expectations here, as per the Cleveland Fed, I made sure to pull this up for you guys, is that the Cleveland Fed thinks that CPI is going to come in at about 3.5% and 3.65% for core CPI. What I did is I made sure that I pulled up the most recent inflation from the last readings here, so we can take a look at the trend. So right now it's basically expecting that core CPI, so the red line is core CPI. They think that the core CPI is going to tick down. So keep in the back of your mind that 3.79. I got to make sure I'm sharing I am sharing my screen. But then they're expecting that 3.65 for the month of April. So that is expected to tick down. And then you also have that headline CPI at 3.5. I do think that this is going to be an acceleration. So you got, so this is going to be a slight acceleration to the upside. We'll have to make sure, like, we definitely want to see a miss tomorrow. Mostly because, so Jerome Powell in the latest meetings, he ended up talking about how, so he ended up saying that he does expect inflation to be a bumpy road, and it's going to take some time for inflation to actually come back down to where that sustainable 2% growth. They have that modeled for about 2025, 2026, if I'm not mistaken. So like mid 2025. So that's going to be next year is what they're thinking. And then we should leave this year at about a 2.5, 2.6% PCE, not CPI, PCE. And then usually what ends up happening is from the PPI data and then the CPI data, we get the PCE numbers, which is usually why PCE is a non-material, like a non-cataclysmic event, where CPI and PPI tends to move the needle a lot more. So essentially what we're looking for here is we're looking for a stabilization in this inflation number. And this is going to be a major market mover, in my opinion, more or less because, so let me take a drink of water here. So if you guys, like I mentioned here, for the better part of this year, we've seen 3 or 4 higher inflationary readings, which basically tells us that right now it's like how high to the upside is inflation actually going to end up going? If we see that miss to the downside, that can tell us that inflation should actually start inflecting downward. And this will be a very bullish development for the markets and probably lead us higher, especially in long beta or in high beta, long duration stocks, which is typically what I end up holding. So a lot of those longer duration stocks will catch a bait if inflation comes in lower. If it actually comes in hotter, I do fear that. So like, let's actually go to the S&P 500. I'm going to share my screen here. I do fear that that's going to be that catalyst. So I ended up coming up, I think about 3 or 4 weeks ago, where I drew out what I thought that the S&P 500 was going to do. I haven't changed anything there. So essentially what I ended up thinking is on that first leg down, I thought that there was going to be an ABC wave down, basically saying that I think that we're going to end up reaching that 200-day moving average, which is where we should see some sort of market bottom at that 200-day moving average, which I think is definitely in the cards, or at least going back and testing that black line that I outlined right there as some sort of structural support. Now that actually makes a lot of sense. And I do think that CPI and PPI has a strong ability to be that catalyst that can actually see a 4 to 5% move downward in the markets, or if inflation ends up coming out better than expected. Because if we think about the whole picture, earnings have been coming out stronger. I think Q1 earnings have been coming out stronger. Now we're in Q2, right? So talking about Q1 earnings, that's basically the last quarter's earnings, and guidance has been coming out stronger than expected, which basically means that if the S&P 500 companies are coming in, I think it's been a 5 or 6% beat on earnings. Essentially what this means is that, hey, if the companies are reporting better than expected earnings, like why should the markets actually crash, right? Inflation would be that catalyst. And it's not necessarily inflation that would be that catalyst. It would be the response in interest rates. So if inflation comes out higher than expected, then interest rates should rise. If interest rates rise, then that should further fuel the recent deterioration that we've seen in the economy over the past, let's say, probably 1 to 2 months, where you've actually seen like that vehicle market really become shaky. And this is also weighing a lot on the tech sector, XAI, right? So like, I'm not talking about Microsoft, I'm not talking about Amazon, I'm not talking about NVIDIA. I'm talking about basically every other tech company out there right now, where it is pretty obvious, and especially the vehicle market, just like Tesla, where I do think that if interest rates go up even further, this is going to put more downward pressure on the economy. And I do think that downward pressure on the economy would be that thing that would actually lead earnings and earnings expectations lower, which I do think would be that perfect catalyst to actually push us down about another 4 or 5%. So like, why is this such a big deal? And what are the risks that inflation should actually see some sort of reacceleration? And that's actually what I wanted to talk about here today with you guys too, it's like looking at inflation. I mean, yeah, I can sit there and make predictions about the markets and say, if inflation comes out hotter than expected, we go down. If inflation comes out lower than expected, we go up. It's pretty simple. And I think that that's the way that a lot of people think about inflation data tomorrow. So that's kind of a no-brainer. But more importantly, what are the risks for the economy longer term? So in the medium and longer term, and like, what does this actually mean in the grand scheme of things, like from a consumer, from somebody who's living in America, and then also an active stock market investor? Like, are we actually on the verge of a 1970s style inflationary episode where we actually see long-term interest rates actually start to see some sort of secular move upward? And from like what I'm seeing right now, this is what I was talking about. If you guys weren't at the beginning, because I can see that there's been quite a few new people actually join. What I ended up saying in the beginning is I do believe that right now in this election year, Americans and voters and money managers and politicians all alike are thinking about the same thing, and that is inflation and interest rates. And I do think that right now America is at a major inflection point, and it all comes back to how money is created and the U.S. government debt. So this is actually really important to talk about. So when we actually think about where inflation even comes from in the first place, what we do, we actually have to briefly touch up on history about the major inflationary episodes that came before. Historically, what we've seen that money growth and inflation is historically correlated, right? So when there's too much money growth in the economy and not enough goods, basically what we end up getting is inflation, right? This is basic principles of supply and demand. And you can actually see that back in the 1960s and 1970s timeframe, there was actually a perfect correlation. So you can see right here that we have this basically surge of money supply, close to about 10% year over year growth. We see inflation start ticking upward. This actually started in the beginning of the 1960s, where the inflation rate in the beginning of the 1960s looks like it's about 1.7%. But money growth started to gradually accelerate. I do think it was partially due to the baby boomer population. That's for a whole nother video when I actually talk about how money is created. But now we actually start seeing that money growth steadily increased over the coming years. And then what we actually saw is this crazy correlation. So remember, the blue line right here is the M2 growth. And then the red line is going to be the PC or the CPI. I did CPI just for simplicity's sake. So we actually see that CPI was decreasing. Then money growth actually ended up going up. And if I added one more dimension to this, if I added interest rates, but I'm not going to do that because it might be too noisy. If I added interest rates, you'd actually see that interest rates are moving in an inverse correlation to the unemployment rate and CPI. So that's just for a whole different chart, like I mentioned. But interest rates, and so basically what was going on right here at this time frame is that they were lowering interest rates, which spurred money growth. So you see that M2 growth actually kick off. Everyone got really excited. They said, okay, interest rates are coming back down, time to borrow. This in turn ended up creating another rise in inflation. Once again, seeing money growth collapse down to it went from about, 13.3% all the way down to about 5%. Once again, seeing CPI soar. And if you actually looked at another chart where you actually looked at unemployment, CPI and unemployment were going up at about the same time. But once unemployment hit like a certain mark, that's when you actually saw CPI come down. So once again, that created a downward pressure on the inflation, coupled with a decline in like money growth. And then also in the 1970s, same thing, right? And I think that's kind of self-explanatory, where you actually see that inverse correlation, where you see money growth go up, CPI goes up. Sometimes it doesn't always work like that, especially like in this episode here in 2009, where you saw money growth go up, and then CPI actually stayed relatively stable for a very long period of time, about 10 to 15 years after the global financial crisis. But then obviously, I think that's pretty self-explanatory. That's the 2020 pandemic, when the government released a bunch of stimulus. Okay, so with the money growth, why is that important? Well, that really has to do with like how money is created, right? So I'm not going to go too much into the nitty-gritty details about how the fractional reserve banking system works. But more or less, money growth is really created, or money is created, I should say. Money is printed in two different ways. It could be private. So privately, this is basically where banks are lending out money to the individuals. So like, let's say that I want to go out and buy another house, but I don't have all of that money. I put my 20% down on that house. The bank lends me the remaining, let's say, $320,000. Average price of the home is $400,000. So I'm just doing some rough math. So that they lend me out that $320,000. What that essentially does, this creates money, right? So the bank doesn't actually have that money, but they create money, and that $320,000 that goes towards a home's construction. So this provides people jobs. This essentially, goes towards commodities that are built in the house, the furnishings in the house, the utility bills, et cetera, et cetera. So the list goes on and on. But essentially, that $320,000 is created out of thin air. And the private individual banks can do that. That's at its nuts and bolts how the fractional reserve banking system works. Now, there's another way how money is also created as well. So going back to like what I was showing you here, is that this CPI, or this M2 money growth, was predominantly led by government spending. So during 2020, if you guys can recollect, that I think $5, $6, or $7 trillion was spent. So like some obscene number, like 35% of all money in circulation. So I can actually adjust this graph here and show you guys exactly what I'm talking about. So let's remove CPI, and then we'll adjust the M2, and we'll just do billions of dollars. So you guys can actually see that during this 2020 pandemic timeframe, they ended up creating, we went from $15 trillion, essentially what it was, basically 2019, end of 2019, early 2020, and then all the way up to $21 trillion. So, I mean, take 6 divided by 15, and that's how much the money supply grew by over the course of basically 18 months. What this ended up doing is this ended up flooding the entire economy. This is a huge reason why we ended up having inflation. This is also the reason why we had a financial bubble too. If you guys can recollect the ARC bubble, the ARC innovation bubble, this was like hand-in-hand correlated. When you print so much money, what ends up happening is you overheat the economy because you basically have, think about it as like a tidal wave of money coming through the economy, and this essentially creates a ton of inflation. Now, so as we saw this surge in inflation, it's important to recollect or to notice that this inflation wasn't like the 1970s style inflation. This was a lot more like, and I actually really like Lynn Alden's article here. I made sure that I wanted to show you guys this. So the 1970 style inflation was predominantly led by the private sector and partially offset with the government spending. So remember back in the 1960s, I'm not sure if you guys learned too much about this in American history, but the Guns and Butter program. So there's all sorts of new social programs that ended up coming out in the late 1960s. This was basically the government spending more money. Then you tie this with breaking off from the Bretton Woods system, where the U.S. dollar was no longer backed by gold. And then also you had one major thing that's very, very different from today, and that you had the baby boomer generation coming to home buying and basically vehicle buying age. So in the late 1960s, early 1970s, that puts them at about 20-something years old, the whole baby boomer generation, which was just this massive increase in the birth rate in the United States after everyone came back home from World War II. That's essentially what the baby boomers are. So this created a private sector explosion of money growth. Today is very different. Our birthing rates are from a demographic perspective, our fertility rates are like 1.37. I think I actually ended up seeing 1.4, 1.5, no more than 1.5, that's for sure. So our demographics are structurally different. But what's different between now and back then in the 1960s and 1970s is we have a crazy debt to GDP ratio. So the government has this extremely high debt load. And now this is where things really start to get concerning. So the Federal Reserve back in the 1960s and 1970s figured out that the way so Paul Volcker actually ended up coming out and he said that the way to control inflation is to, number one, kill inflation expectations, but also to control the money growth. So going back to Lynn Alden's chart here, you can actually see that money growth cratered. Where is it here? 19. So the broad money per capita growth. So you can actually see that late 1970s, this is about the time the Paul Volcker era came to be. So he ended up basically cratering money growth, and you can actually see that here in the year-over-year growth in the M2. So let me change this. I think that this chart's just a little bit better because of how volatile this is. So let's go share this tab instead. Okay, right here in this I got to make sure I'm sharing my screen. Yes, this so like the 1980s time frame, you can see that M2 money growth steadily declined for the rest of the 80s. Paul Volcker instituted his interest rate hikes like right about in this area, and then it steadily declined all the way into about 1996. So what's really important here is that during this time frame, the higher interest rates impacted the private sector enough to where and the debt to GDP ratio was low enough to where essentially if you raised interest rates, the government deficit wouldn't go up anymore. And keep in mind, like I mentioned, that there's private growth. So that's basically where individual banks can lend out money for money creation. And then there's also government spending, which is what happened in 2020. And this can also create inflation because this also creates money. So government deficit spending creates money. Back in the 1970s, they had the ability to raise interest rates on the private sector to essentially slow the pace of money growth. But now these days, they're basically taking, and I'm not any sort of macroeconomist, but I'm, smart enough to understand that if you're raising interest rates on a higher debt load, what you're basically creating is you're creating a higher deficit spending when it comes down to the government, like the U.S. government. And you can actually see that right here. So the government has been, so like right here, you can see in 2019 and 2020, where you can actually see that debt to GDP, or so the deficit spending, sorry, I'm fumbling up on my words because I have so much stuff in my head that sometimes it's really hard to actually communicate all this stuff because it's like all this stuff ties together. I'm trying to effectively be able to tell the story about why I think that we could actually head towards a period of structurally higher inflation until the government figures out their stuff. Anyway, so you can actually see that the deficit spending ended up, that was during the pandemic where you can actually see the deficit. So the deficit, like the higher this negative number is, this is the higher the deficit is, basically. So like back here in the Bill Clinton era, that was during basically the only time in the past, 100 years. So maybe past 40 or 60 years that we actually ran a surplus, and this actually decreased the debt. But now we've been deficit spending for the better part of it, like especially since 2008. So during the global financial crisis, the government essentially printed a bunch of money. They increased their deficit spending. So basically, the government is getting larger, and which in turn, going back to this chart, is increasing the debt to GDP ratio. So right now we're at this crossroads where a majority of our economic growth has been fueled by government spending. And you can really see that in the way that they're deficit spending. And you can see that right here. The reason why they do this is that inflation and deflation are almost always like these two opposing forces that are working against each other. Now, what creates deflation is that you can actually, so like demographics, like I mentioned before, with the low birthing rate, that can create deflation. So Japan is dealing with that problem right now. Technology can also create deflation. So you have these structural deflationary trends in the United States. So the way that the US government has been able to offset that is by printing of money. So they've basically been printing a bunch of money to create inflation by printing more money than the economy needs, right? Deficit spending. And in turn, what they're doing is they're creating like this balancing act. So like imagine that there's a balloon right now, and there's a hole in the balloon, right? The way that the government is inflating this balloon and making sure that the balloon is stable is that they're basically pumping a bunch of air into it, right? That's going to be the deficit spending. But there's still this massive hole in the balloon. So we still have the structural deflationary trends that are taking hold. Now this is how things have been since like 2000, right? That's how things have been for the majority of the past like 20 to 25 years. But 2008 was a symptom of that. And now what's going on is like, as it stands here today, the government is continuing to deficit spend at a higher percentage of GDP, higher percentage of debt to GDP ratio. Now, what's really concerning to me is actually this, right? And this is why I think that we're actually going to go towards a structural, I don't know if this is actually going to happen, but I do think that this year's election is massive when we're thinking about this, right? Like as educated voters, as politicians, or money managers, whatever it might end up being. Right now, like this chart is probably the most concerning thing in the world to me. And the reason why it's concerning is that, like I mentioned before, there's two ways that we can print money: through the private sector or the public sector. But the problem is that right now interest rates are being jacked up. And so basically the Fed is fighting inflation in a 1970s style way with the debt to GDP ratio that's, it used to be back here in these days, 35%, right? Now it's 120%, right? So what ends up happening is, and I think that this chart right here is really going to bring my point home. What ends up happening is that as the government is printing a bunch of money, the interest rates or the interest rate payment on just the debt alone is now, so like you can actually see it, where it's actually going to be this 514 billion baby blue. So this right here. So the interest rate payment, and this is just from the beginning of the year now till April. So this isn't even updated for May. It is now becoming so big. So it's actually becoming bigger than it's going to eventually become bigger than Social Security as projected by this, right? So assuming that rates remain stable, this is from Bank of America, assuming rates remain stable, that basically Yellen's going to need to roll over new debt to pay for the interest rates. Okay. This is what I'm saying here, right? Now I'm going to make sure that everything that I was talking about, it's all going to come home right now. So essentially what the federal or our government is needing to do is we're needing to borrow to make interest rate payments, right? And what Bank of America is projecting is that we're going to need to borrow $1+ trillion, $1 to $2 trillion to make payments on our interest, right? And now it doesn't take a genius. You just got to know basic financial management, right? If you're taking out additional credit on your credit card to make your interest rate payments, right? But you're not actually paying down the principal. What ends up happening is you get an increased debt load that becomes parabolic. that becomes exponential over time, right? So the reason why this is such a big deal is that right now the Federal Reserve is raising interest rates, or they've raised interest rates to about 5.25 to 5.5. That's what the federal funds rate is currently at. And then the 10-year yield, going back to the 10-year yield, is currently 4.49%. So essentially that the government is borrowing at higher rates on the long end, borrowing at about 5.3 on the short end. And what this is doing is this is creating an exponential curve, as indicated by Bank of America, shown by this chart right here. And essentially, to really wrap up everything and basically share what I'm saying right now is like, we got to get, I'm genuinely concerned that we're actually going to go towards an inflationary episode here for the next 5 to 10 years. And the only way that we can actually get out of this is if we inflate our way out of it, because the government isn't going to control their spending. So going back to this right here, right? So the U.S. government, what they're going to need to do is they're going to need to figure out what to do with this pie graph right here, right? So either they cut out Social Security and start balancing their deficit, or their defense spending, or you got national defense over here, $500 billion. So now I guess interest rate payments are higher than our defense spending, or the Federal Reserve ends up just lowering interest rates and letting inflation take its toll and letting long-term demographics take its toll. That's if I'm correct with this hypothesis of that we're going to go into a structural inflationary environment, and that the way that the Federal Reserve is basically combating this is in a 1970s style way, but it's not so, and this is also pretty interesting to show you guys. Let's go back to the debt to GDP ratio. The last time that the debt to GDP was actually at this level here was back in the 1940s. So let me actually do this with my face. Okay, maybe just do this. Okay, I'm going to just talk on this so you guys can actually see the 1940s. Back then in the 1940s, when we had a debt to GDP ratio that was this high, we just got out of World War II. And basically the government has been spending like we've been in a wartime, right? So what ended up happening back there in the 1940s? So we can actually take a look at this. So let me actually open up a new chart, new graph here. Let's do CPI. Actually, I don't know if it's actually going to go back that far. So if you go back to World War II, actually 1940s CPI. So let's do that. 1940s CPI. So back in the 1940s and the 1950s, CPI ended up going through 3 major inflationary bouts. So essentially what ended up happening is that after the war ended, everyone came back home, price controls were lifted, and this is perfect. Okay, I got it. This is also from Lynn Alden, believe it or not. Okay, so let's share this one, share the screen. Okay, so this is actually the same graph right there. Okay, so you can actually see right here. I'm going to zoom in, share this tab instead. Okay, boom. So back in the 1940s, right? So we have these 3 major inflationary bouts. That was essentially how they killed the debt to GDP ratio, is they let inflation go. And they kept interest rates lower during that time period too. So back in the 1940s, after everyone came back home, we had a major surge in CPI up to about 12%, but it was very short-lived. But the Federal Reserve, they didn't raise rates during that time. They actually kept rates relatively steady. So they didn't even try to combat that in the way that they're combating it right now with a higher debt to GDP ratio. So essentially, what we ended up getting as a result here was a lower debt to GDP ratio, and the debt to GDP ratio was reduced specifically through inflation, right? From that time period all the way up to the 1970s. So I'm concerned that that's exactly what we're going to have to do now. Now, I'm not 100% sure if this is what our future holds, because if this is the case, so it's okay, what about my stock portfolio, right? So believe it or not, it's actually a good thing for stocks because you do, so it's not necessarily, it's important to understand that stocks don't hate inflation. Stocks hate what comes after inflation. So stocks typically respond to corporate earnings, right? So believe it or not, like stocks don't move on liquidity like a lot of people say, but they do, but they don't, right? They move on earnings and earnings expectations. And what ends up happening is so during the process of fighting inflation, the Federal Reserve raises rates historically. When they raise rates, this creates an economic recession. So with this economic recession, this is essentially causes downward revisions in forward EPS. And this downward revision in forward EPS is what creates the bear market and lower valuations for stocks just in general. So during the 1940s, and I can actually show you guys this. So I'm just kind of recollecting all this information because I've looked at all this stuff before. During the 1940s and the 1950s, the stock market actually ended up rallying. And that was actually the beginning. Since 1942 to 1969 was the beginning of the secular bull market that began after the Great Depression. So let me just make the point here. Okay, we're going over on time. I'm already talking for about 45 minutes and I feel like I'm kind of going around in circles. So more or less, it's like, do I sell out of my stocks? What do I do? What do I do with real estate with all this information that we're being told? Because this is a lot of information. So essentially, I'm going to simplify exactly what I'm saying here. I think that we're actually heading towards a structural period of inflation. And we're heading towards a structural period of inflation because the debt to GDP ratio is extremely high. And it's getting exponentially bigger, not because the government is spending more on Americans or even more on like innovation programs or NASA or defense or anything like that. They're spending more on their interest rate payments. And this is actually going to create a wider and wider and wider gap to where at some point, if trends just stay the way that they are, the interest rate payments are going to supersede Social Security, Medicare, defense spending, and eventually become the combination of all three. If that ends up happening, then the government will have no choice either to lower interest rates, which is probably what they're going to have to do, and inflate our way out of it like they did in the 1940s, right? Or they keep interest rates high, and then we actually end up going towards this like Argentinian style hyperinflationary environment where the government cannot even make their own interest rate payments, and which is going to crush the United States dollar. And that's just a mess, right? So what the probable and the most likely scenario is if this hypothesis is right, that money is created, that money created is what creates inflation, right? Or I mean, there's a lot of different things to think about. Macroeconomic projections and predictions. It's like shooting fish in a barrel. Like sometimes you're going to hit one, and then a lot of the times you're not. But for me, the way that I'm thinking about this is like, I think that right now is probably one of the most important times to invest because the way that the future looks like, especially when it comes down to deficit spending, hedging inflation, you can only do that in like two different ways: real estate or stocks. I mean, maybe crypto, probably gold. And this is probably why gold is in a new bull market too, because gold bugs, they see this and in a lot of other countries, because countries actually buy gold in the anticipation for the weakening of the US dollar, or, historically it was an inflation hedge. It hasn't been that way for a long time, but especially when the reserve currency system, I mean, this can go down a really, really bad rabbit hole. So I do hope that the message that I'm really trying to portray here is that as educated voters and as people who are, proactive in the finance community, that they take more of a reckoning to this deficit spending and what Congress is doing, because it's both sides of the aisle that's doing it right now. Because right now, the way that it looks is if they don't get this under control, and especially because the Federal Reserve is going to lose this battle if them raising interest rates is the thing that's creating inflation in the first place, because of the deficit spending, right? So like the Federal Reserve is going to lose this battle. And there's really nothing that they can do about it. This becomes a federal government problem. Okay, guys, I think I've been talking for about 45 minutes, actually 30 minutes. That's all I got here for you today. Actually, no, for 45 minutes. That's all I got for you guys here today. Looking forward, my calls or my live streams are going to be on Sunday night. This was just an exception here because it is harder for me to talk in between like 4:30 to 5:30 Central Standard Time, which is what I currently am in. But look for me next Sunday. I'll be talking about probably this week in review a lot of the earnings that are going to come out. More importantly, like what the inflation data is actually end up saying, and like what the directions for the markets are. I know that right now, from like a bullish or bearish in the short term, I'm super neutral. I think that the next 5% move can be up or down. I think the next 20% move is likely up. All right, guys, until next week, of course, you stay classy.